Today, we're diving deep into a tech giant, Salesforce, and we're asking one massive question. After being stuck in the mud for a while, is it finally ready for a huge breakout?
So here's the puzzle, right? The stock market is soaring, hitting new highs left and right. But Salesforce? It's just stuck. It's a real head scratcher that's confusing a lot of folks. So what is actually going on here?
Okay, before we jump in, just a quick but really important note. This is not financial advice. All the info in this explainer is just for educational purposes, so please do your own research before making any investment decisions. First, let's talk about this standstill. It's pretty wild. While the market's been on a tear, Salesforce stock has been baffling everyone by pretty much going nowhere. Right now, the stock is hovering around $239, but the number you really want to watch is 230. That's a super critical support zone, kind of like a price floor that's held strong before. The fact that it's just floating above that level, yeah, traders are watching this like hawks. But, a stock price is just one piece of the puzzle. When you peel back the layers and look at how the company is actually doing, well, the story changes a lot. And this is where it gets really juicy. The company's latest quarterly results, they paint a picture of real strength that just doesn't line up with its sleepy stock price. First off, revenue. They didn't just hit their target, they blew past it. A solid beat. And then, you guessed it, same exact story with earnings per share. Another beat. The big takeaway here is that fundamentally, the company is absolutely crushing it. And this wasn't some lucky break. Management felt so good about things that they actually raised their forecast for the rest of the year. That's a huge sign of confidence, telling everyone they expect this momentum to keep on building. So, where's all this good energy coming from? The answer, in two simple letters, is AI. Salesforce is basically strapping a rocket to its future growth, and it's powered by AI. This growth is really coming from two main areas, their data cloud and their whole AI portfolio. And look, these aren't just trendy buzzwords. These are the tools that help their customers get a handle on their data and weave AI into everything they do. And it is already working. Big time. Together, these AI-focused parts of the business are pulling in over $1 billion in annual recurring revenue. For a new initiative inside a company that's already massive, that is a huge deal. But it's the speed of this growth that is just jaw-dropping. We're talking 115% growth year over year. That's not just impressive, that's the kind of lightning in a bottle growth that can totally transform a company. So to capitalize on this incredible AI momentum, Salesforce is also making some really clever changes to its strategy. It's all about speeding up adoption and bringing in revenue even faster. Their new game plan is all about getting this powerful AI into more hands more quickly. They're launching a new product, Agentforce 3, rolling out a new flexible pricing system, and really pushing their biggest clients to get on board faster. So what are these flex credits? Well, you can think of it like a pay-as-you-go plan, but for massive enterprise software. This makes it way easier for new customers to get started and for current ones to experiment with new AI tools, which, in the end, drives more use and more money. Okay, so you've got a stock that's lagging behind on one side. And on the other, you've got strong financials, an explosive AI business, and a smart new strategy. How in the world do analysts make sense of this disconnect? This is really the core conflict right here. On one side, you've got the market being pretty pessimistic, which you see in the flat stock price and some doubt about AI adoption. But on the other side, you've got undeniable strength, like great earnings and that mind-blowing 115% AI growth. This gap is exactly what the whole investment idea is built on. You can see this disconnect so clearly in the stock's valuation. The company's forward price-to-earnings ratio, which is just a fancy way to measure how expensive a stock is, has dropped by nearly 30% this year. Basically, the market is saying the stock is getting cheaper, even while the business itself is getting stronger. It just doesn't add up. And because of this growing gap between the stock price and the company's actual performance, the analyst outlook has been upgraded to a buy. The argument is simple. The market's pessimism has created a fantastic opportunity.
And here's the number that really puts an exclamation point on it: a new price target of $350 a share.
So, what does that $350 target actually mean? Well, from today's price, it suggests a potential upside of about 45%. That's a really bold call, and it shows a ton of confidence in the company's AI-powered future. Which brings us right back to our big question from the start. With solid fundamentals, a booming AI business, and a valuation that seems totally out of whack with its performance, is this tech giant finally truly on the verge of a major breakout? The data certainly suggests it's a question worth paying very close attention to.